the last couple waves of inflation that we've had look just like the waves of inflation in the 1970s, where we've seen progressively larger waves of inflation. And I think a third wave of inflation, bigger than the first two, is coming. Silver is looking extremely attractive. Plus, it's actually having an interesting structural element here in that demand is growing year over year, but supply is shrinking. So whenever you have a growing demand with a shrinking supply, one thing is going to happen: price is going to go up, and that's the case for silver.
Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for being with us today. My guest is Alan Hibbard. He's a precious metals specialist at GoldSilver.com. Alan, great to have you on the show. And I was just saying to you before we started, the story of inflation is one that we have been talking about almost ad nauseum, and the Fed and the equity markets. But, going into the side of what's happening in the metals side of the market is such an interesting part of the story. And we haven't really gone into that very much here on the show. So I thought maybe we could start by getting from you your thoughts on what you think the major stories are that are right now playing a role in the precious metals realm. If anybody's been paying attention to gold specifically, what a bull run. And I know that's something that you're talking about as well.
Yeah. Well, first of all, thank you for having me. And yeah, there are a few stories here. Inflation is probably the biggest one. That's always on everybody's mind. It's either a big concern or a little concern, but it's always a concern. So that's inflation. A second one is sort of these long-term capital flows that we see from the centralized to the decentralized part of the economy, basically from the stock market to precious metals. And these are long-run changes. And the third story is the type of bull market that we're seeing right now in precious metals. And it looks eerily similar in a good way to the 1970s. So those are the three pieces that I would call to everyone's mind.
Yeah. What about silver, though, Alan? I feel like silver is sort of like the little brother or sister to the big brother, sister gold. Gets a little bit less love. But what are your thoughts there?
Yeah, great question. So first of all eyes are on gold because it's making all-time record highs almost every day lately. Silver is not at all-time record highs, but it is above $30 an ounce. Its all-time high is slightly over 50, around 52. So it's not at all-time record highs, so people don't notice it. However, it is up more than gold already this year. It's up over 30%, where gold is only 20% this year. So those are both big numbers. But yeah, silver typically is an industrial metal. The majority of silver that's mined in the world is used in industry, whereas that's not the case for gold. It's primarily a monetary metal. But once we get these big bull markets, all of a sudden, people start thinking of silver as a monetary metal as well. They're reminded that it does have that monetary role, and it does have a place in investor portfolios, not just businesses who are building electronics and solar panels and so forth. So silver is looking extremely attractive. Plus, it's actually having an interesting structural element here in that demand is growing year over year, but supply is shrinking. So whenever you have a growing demand with a shrinking supply, one thing is going to happen: price is going to go up. And that's the case for silver.
Yeah, fascinating markets to be tracking. And you and I were just saying right before we started, you kind of sleep a little bit on metals because a lot of people put them in their portfolios. Advisors are putting in there as hedges against inflation or downturns. But you're not paying attention to it every day. And all of a sudden you look at the charts and you go, wow, what have I been missing? So that's really an interesting side of the story. But let's talk about the inflation part of the story. So here at CIO at UBS, the view is that the Fed is going to cut rates 25 basis points in September, another 25 in December. We're still in for a soft landing. But there are concerns. Like, look, from an economic theory says if you're cutting rates too quickly when you're still in a decent economy, there is a chance for inflation to rise again. Now, obviously, we don't know what's going to happen. It's an interesting market that we're in, and Jay Powell certainly has his work cut out for him. But what are your thoughts about that potential reinflation? And do you think that looking forward, especially with rate cuts coming, that's a possibility?
Yeah, I do think that's a possibility. In fact, that's my base case scenario, because like you said, when you cut interest rates, that's a stimulative policy. Basically, you're incentivizing businesses to take out new loans, and that means new dollars are created. That's the old definition of inflation, right? It's expanding the money supply. But the new definition of inflation is rising prices. Well, when you create all those dollars, they have to go somewhere. They're going to bid up the prices of goods and services in the economy. they will also bid up the prices of financial assets. So we are absolutely going to get a bunch of inflation. The question is, do we get a little bit of inflation? Do we get a lot of inflation? When does it arrive? My stance is it's definitely coming. And if you look at the similarities in the waves of inflation that we have, I think we have a chart on this. The last couple waves of inflation that we've had look just like the waves of inflation in the 1970s, where we've seen progressively larger waves of inflation. And I think a third wave of inflation, bigger than the first two, is coming.
Yeah, I think, when I look at that chart as well, you can sort of see there's such a cyclicality to how it works. And people look at 2020 and they think, well, it was a pandemic and it was something that was unusual, 100 years of that and in modern times. But, there are things to say about that. But, when you think about, for example, looking at things like where the Fed is going, and you're also looking at where to put your money to work, you're also looking at like the M2 money supply, which is savings deposits and money market funds. You have a theory that perhaps that plays a role here as well.
Yeah, exactly. So M2 is one of the broader measures of the money supply. So larger than M1, of course, larger than base currency. And what we saw during the COVID era was a massive spike in M2 money supply, essentially massive currency creation. And then it dropped down. It actually declined year over year, which is fairly unusual. That hasn't happened in over 80 years, I believe. And then it started coming positive again. So now we're seeing another expanding money supply. And like I said before, all those dollars that get created, they have to go somewhere. They're going to bid up the prices of goods and services and financial assets. And so investors should prepare for inflation. And I think the best way to do that throughout history is absolutely precious metals. They're actually designed to be a hedge against inflation. So I think gold and silver are very logical choices to protect against inflation.
Yeah, and that's always been something that we've talked about quite often when we do talk about gold and silver as a hedge against inflation. So that's where right now you feel is, for not every portfolio, everybody has unique circumstances, and we always recommend people should speak with their advisors. But for some people, putting some of your funds into a precious metal like gold or silver, for example, is a good safe haven for what might be coming down the pike in a couple of years.
Yeah, exactly. I think a lot of things could be coming. And there's an interesting pattern now that we're seeing. So traditionally, gold is a defensive component of a portfolio. It provides diversification. It's a hedge against a lot of things. It's a hedge against inflation or geopolitical turmoil, social unrest, a lot of possible things. It's good to have there. It has a nice defensive role. What's interesting now is that every once in a while, including this point in history, gold provides an offensive boost as well. Every now and then, it seems to be one of the most attractive investments for increasing your purchasing power and for growing your portfolio, not just for protecting what you already have. So there's really two ways to look at this. One is the Dow gold ratio. And so if we look at the flow of capital from the centralized part of the economy, basically stocks, to the decentralized part of the economy, gold and silver, for example, which no one company or country has control over, we can see a natural ebb and flow. And this here is the Dow gold ratio since 1900. Notice it's a logarithmic chart, which means every time you go up a fixed step, you're actually doubling that ratio. And the ratio, of course, is just calculated by dividing the Dow Jones index by the price of gold at each day. And you can see these natural ebbs and flows, ups and downs. Every now and then, every 30 years or so, we see a massive swing from stocks, which have been overbought, into gold, which essentially were unloved and ignored up until that time. And when gold and silver become overbought, then things start to swing back. People leave that trade and they start to buy stocks again, and that will last another 30 years. So the point we're at now is an elevated Dow gold ratio up around 16. Normally that ratio is down around 8, and it often swings as low as 1. So if I had to just take a bet, knowing nothing else other than this ratio, if I had to bet for the next 10 years, would I rather buy stocks or would I rather buy gold? I would put my money in gold, and I would expect gold to outperform the Dow by a factor of 16 if this ratio reverts as it usually does.
Yeah, Alan, thanks for that. It's a really interesting theory and way to look at it. But really quickly before we wrap, though, gold is sitting near all-time highs. It's about just under $2,500 an ounce. Even at these and we were talking like 25 years ago, it was like $290 an ounce. So even at these levels, you still think it's a good time to be looking at gold?
Yeah, that's a great question because a lot of investors might be tempted to think, oh, the bull market is over. I missed it. It's at all-time highs. That couldn't be further from the truth. If we compare today's bull market to that of the 1970s, you can see that we still have a few more years to go, and we still have the biggest part of the move to go. Just to remind investors, for folks who don't know, in 1979, the price of gold doubled in a year. It had over a 100% return in 1979, and that capped off a 10-year bull market where gold returned 25x in 10 years. So we're in this long-term gold bull market and a silver bull market for that matter, and gold still has another big move to come. If the shape of this bull market continues to match the one from the 1970s, we could see gold going to $9,000 an ounce in the next 3 years or so. So I absolutely do not think this bull market is over. We still haven't seen that blow off top, and I do expect we're going to get it in the next 2 to 3, maybe 4 years.
Alan, really good stuff. I appreciate you coming on and talking about this because it's certainly one way to look at what potentially could be coming down the pike. And clearly there's some opportunities here. So very, very much enjoyed our conversation. Thanks for joining us today.
Hey, thank you, Anthony. Appreciate it.
Thank you. Alan Hibbard again from GoldSilver.com.